What's up everyone, it's Karthik with MoneyVest. Welcome on board for our Market Open live stream. If you guys can see me and hear me, just give me a thumbs up. I just want to make sure the audio and the video is good and there are hopefully no issues with the audio or the video. So just give me a thumbs up. Market is open. So I came live right as the markets were starting to open here in New York. It's just over 9:30 a.m. Eastern. We've got Jerome Powell's speech at the Jackson Hole Economic Symposium in about 30 minutes. So at 10 a.m. Eastern is when Jerome Powell is expected to address at the Jackson Hole Economic Symposium. Again, if you guys can see me and hear me, just give me a thumbs up. Just want to make sure the audio and the video is good. And yeah, the next 30 minutes, I'm just here to chat. I'm just here to discuss my thoughts and my analysis on the market. And yeah, if you have any questions, let me know. And more than happy to answer, more than happy to help in any way I can. And we'll take a look at the markets together, as there has been obviously a little bit of rotation out of technology over to other parts of the market. And as a result, volatility is a little bit over 16 right now, with of course market breadth that continues to somewhat improve regardless of the technology sell-off. The market breadth is getting better. That is one of the signs that we are seeing this market broadening out to other parts of the market as well. So we do also have a poll. Make sure that you participate whether Jerome Powell is going to be hawkish or dovish today. So make sure that you participate and let us know what your expectations are. And please do me a favor, share this live stream with as many people as possible. I've already shared the live stream with our Discord. So again, do me a favor, share this with your friends, family, traders, and other investors that can join us and listen in on what Jerome Powell has to say, which, like I said, is going to be a very, very important speech because, you know, in the past, Jackson Hole has been a defining moment almost every year, and policy has obviously changed, over the course of the last couple of years as markets started to expect more rate cuts in 2025, but then we obviously got adjusted back down to just 3 or 4 rate cuts, and right now it's sitting at about a couple rate cuts in 2025 as inflation continues to be a little bit of a lingering problem for the market as well. So I'm trying my best to be obviously a little bit more energetic because I have been exhausted, to be honest. Like it's not been easy flying over 16 to 20 hours, especially in this part of the world, which I'm very excited to visit finally, because can't even imagine. I mean, it's like midnight here right now. It's 9:30 over in New York, and here it's 11:30 p.m. So we're talking over 14 hours ahead. Sydney is compared to New York, which of course is a challenge of its own, especially if you are a trader trading the U.S. markets. Like I said in my previous updates, the best time zone in my opinion is the London time zone, where you can trade multiple markets and still be fine and not have to worry about being up at night. But it is what it is, it is what it is. You gotta make it work, because markets don't stop for anybody. Anyway, so we got SoFi here down about 1%. Nvidia is about consolidating sideways. It's still down a little bit over 1.3. We got Palantir, which has been selling off aggressively, as we already know. It's down a little bit over 18% from its all-time highs. So at one point we were obviously at 190. We got down to as low as 140, 25% lower, and right now we're down about 18, almost 19% from all-time highs. Of course, Palantir has seen a little bit of its valuation compress, almost 20% for the right reasons, considering that it was, of course, incredibly overbought and expensive as a stock as well. So what is everyone's expectations? What are we thinking? Are we going to see a green or a red day for the market? Because this is also 5 days of losing streak for the S&P 500. And so if we can break that streak today, that would be great. But S&P 500 has been down for 5 straight weeks. We've seen red across the board. And of course, September seasonality is right around the corner as well. So Hayden, let me know if you come to Melbourne. Maybe we can catch up. Yes, definitely. I know there's a lot of people in Brisbane. There's a lot of people in Melbourne and Perth. This time around, I just wanted to explore Sydney for 5 days. It's a very, very short trip. But yeah, I mean, so far I've just been exhausted out of my mind because during the day I get like really, really sleepy, although I am on India or Dubai time zone. But since I caught a red eye yesterday, I was not really able to get any sleep. And when I got here, I was like as exhausted as one can be. And then, I pretty much slept the entire evening, or at least in bits and pieces, because I still were getting a lot of calls and everything. And my plan really is to try to get some sleep tonight, so I can wake up fresh tomorrow morning. So we'll see how that goes. But yeah, man, it's not easy. It's definitely not easy. Bruce, it's been a long time. I know. How are you doing? It's so good to see you here. I hope you're doing well. And again, if you have any questions, please let me know. I'm more than happy to help. My goal with everyone is to really connect on a one-on-one, more direct basis. So I'm helping you in your journey for trading and investing over the long term as well. And yeah, we're keeping a close eye on multiple different indicators that I like to watch. Of course, volatility is one of them. MoneyVest Index, if you come over, we closed in at 3.58 yesterday. So we're just a tad above neutral markets. So obviously we got up to as much as 3.67, 3.8, 3.99. The highest reading for 2025 was 3.99 back in July. And then once again at 3.97 once again in July. So July was obviously one of those months where we a couple times got up to as much as, greed, almost at greed, but we didn't quite cross those levels. So that's where we are. And market concentration right now, $200 billion worth of inflows, Magnificent Seven over $18 billion at the moment. And of course, the most important event for today is the Jackson Hole Economic Symposium with Jerome Powell's speech coming up in about 20 minutes or so. So we'll take a look at what the markets actually do today and after the speech. So again, if you have any questions, let me know. Obviously, tech has been under pressure, which again is very, very normal. What do you think, Caddy? Hawkish or dovish? I think he's going to be, once again, a little bit more diplomatic about what he says. Jerome Powell is, one of those people that doesn't really give away a lot of information, even with direct questioning. He's very good at deflecting a lot of the questions. So I think his speech is going to be mostly about, where we've been and where we're going. Of course, there's not going to be any definitive suggestions or remarks around rate cuts. I doubt that he's going to be making any comments about what the interest rate policy is going to look like. He's going to give us some color on it, but nothing definitive. But really the markets are very much pricing in for a rate cut in September. And if there are any changes to that expectation, I think that's when the market's going to be more susceptible, more vulnerable to getting shook if we don't really get rate cuts as expected. Because it is all a perceptions game. At the end of the day, markets are nothing but a game of perception, right? You expect something, and if it comes in better than expected, that's a positive sign. If it comes in worse than expected, that's a negative sign. Same thing happens with earnings, guidance, actual earnings, comments from the CEO. All of that matters and creates this perception. And even if on an absolute basis, if you were to look at it absolute on an objective basis, the company reports incredible numbers, the company reports incredible growth rates, but if it doesn't meet those expected numbers, expected guidance, or the perception is too high that they're going to outperform, like hint, Nvidia's expectations are sky high right now, so can it live up to those expectations is all that matters. Doesn't matter if it's reporting a 200% growth in earnings and massive growth in revenue. All that matters is perception. And I think that's what the markets are trying to get a read on, especially when it comes to Jerome Powell and interest rate policy, because a lot of folks are waiting for that first interest rate cut in 2025, especially the entire real estate industry, the mortgage industry, like all of that is just waiting for rate cuts because there's so much backlog in refinancing activity and new mortgages and new applications. Housing has become unaffordable. So, of course, interest rates coming down is going to be a big jump in activity around real estate as well, and just lending in general. And if there's cheaper money floating around, that of course that leads to more spending, more investing, which leads to a little bit of a boom in, of course, the economy as well. But do we really need that level of quantitative easing right now, given that inflation is also on the rise? Of course, that is for the Fed to decide. But that's my quick take on, what I'm expecting from Jerome Powell. Nothing too direct, but definitely some insights. How about New Zealand? Auckland, 2 hours flight. I would love to. I would definitely love to go there as well. But man, it's just, it's the time zones are really difficult, I feel, depending on what you're doing, obviously. But it's just one of those things where long term, I could not see myself in Australia or New Zealand just purely because of the time zone, right? I don't want to wreck my sleep by trading or investing and making decisions overnight and then sleeping in the morning, right? That would be very challenging, very difficult. I've done that, right? I've done that in India for quite a bit of time, and I know the long-term health consequences. So since then, I've prioritized my health and sleep a lot more than anything else, because if I want to do it for the long term, I've got to prioritize it. But these are beautiful, beautiful countries, and that's what I want to explore. Like, I went sailing this morning, and it was absolutely dead gorgeous. Yes, the weather was not in favor because, obviously I'm coming at a time where, again, seasons is another thing, right? It's all very new to me, where you've got winters in October, November, December, January, February, March. Like, those are the months where you've actually got summer, and this is winter right now. That's why I caught a cold, because as soon as I landed, I didn't expect it to be this cold coming from Dubai and India, where it's the exact opposite. It's like incredibly hot. And so very, very new things that I'm getting used to and learning. But it's been a very interesting and exciting trip so far. But like I said, it's dead gorgeous, both so far from what I've seen Sydney, and I've seen New Zealand online as well on Instagram and stuff, and it's been absolutely amazing. So yes, plans on visiting soon, but yeah, only visiting. I couldn't see myself living here. Excited for September seasonality. Yes, so this is the September seasonality playbook, where September, as I mentioned in my previous market update, is the worst month when it comes to the win percentage. We're looking at 48%, going back as far as 2000s. So 2000s, last 25, 24 years, markets got a win rate of 48%, which again is worse than a coin to flip, and only 12 basis points lower on a median basis. But then if you come back to 1900s, 1950, 1975, the win rate actually gets worse to 42 to 43%. So we're looking at even lower win rates for the S&P 500 for September. So yes, definitely looking forward to seasonality myself as well, as there's going to be more and more deals coming our way. What do you think about Intuit at a current price? And JP might just take a safe answer and say we wait. Yes, I do agree. I think that's going to be what it's going to be like. But let's take a look at Intuit very quickly. By the way, just quick take on the market. S&P is on its way to breaking the 5-day losing streak here, up almost 60 basis points. We've got Nvidia up over 174. Essentially flat, although it has been struggling quite a bit as well. And we got Palantir down about 80 basis points. Let's take a quick look on Tesla, which is also moving at 324, up over 1.4% right now. And then we got SoFi, that is also very flat. So a little bit of liquidity flowing back into technology and Magnificent 7 as the markets look to break that streak here. And look at Intuit, absolutely getting crushed after the earnings, breaking it down. Beat on EPS, beat on revenue. Next support is going to be all the way down at 612, 613. It is not part of my shopping list. By the way, I released the shopping list with the updated fair values and buy targets. There's about 31 stocks right now. I had 5 removals, and I'm going to have 6 to 7 new additions that I'm going to be sharing with everyone very soon. So these are going to be brand new stocks that I've never had on my shopping list before that are going to be making a brand new entrance into this list, which I believe to be super high quality with some very conservative and well calculated intrinsic values and support levels based on fundamental and technical factors. So that is something to also look at if you are looking to build a high conviction list of your own stocks. That is something that you can refer to as well. But Intuit, next support is going to be 615 down to as low as 620. That would be a level to watch. And of course, we got a bit of a gap that it's also leaving behind after this gap down from earnings. So far, green candles. Is Jerome Powell going to ruin the party? That's the real question. But so far, it is good. Enjoy Australia, great country. I agree. It's phenomenal. I need to make popcorn for this. Is 9 a.m. CST too early for margarita? Hey, it's midnight here in Sydney, right? So it's party time somewhere. It's like they say, it's 8 p.m., 9 p.m. somewhere in the world. So, but yes, please do drink responsibly. Nothing too crazy. Let's see, not cutting rates, Q4. Powell will not give much color today, in my opinion. There's still inflation data to come before the decision. I mean, there's always data going to be coming in, right? I mean, if they're data dependent, they're never going to fully have a well-formulated, well-calculated answer for us because they're always going to be data dependent, right? There's always data coming in in the future. So with that logic, there's never going to be a well-formulated speech or decision. So whatever insight he can give us, I think the markets are just going to trade on that, and we'll see if the expectations do change from the market in terms of the interest rates or not. How long until the speech starts, Jason? We've got about 20 minutes, about 14 minutes roughly until the speech. So Jay Powell is going to be talking at 10 a.m. Eastern. So we'll be live, of course, to cover that, and we'll take a look. We'll listen in on what he has to say. And 14 more minutes until Jay Powell starts talking. Here we go. Jackson Hole Economic Symposium, Federal Reserve Chairman Jerome Powell's speech that is coming up right here. Powell's remarks. All right, let's take a look at some more comments here before we get going. 18 minutes, so 14 minutes roughly now. Is SoFi at a good price? Depends on what you're looking for, trading or investing. Obviously, it's going to have different, analysis and different objectives. Going to lead to different understanding of what it is that you want to do. Jason says, hate how my birthday month is a lowest earnings. Take it as a good sign, because if you're going to have some buying opportunities and some good discounts and deals, that of course is going to be good. It's not bad, right? Red for us is always good. If there's good deals, if there's good opportunities, it's always good in the market. At least for us, that's how we've trained and conditioned our mind to believe that red is good. Discounts and deals, market selling off, corrections, pullbacks, all of that is good news. Joe says, cool, I have an excuse. I'll tell my wife you approved. It's happy hour somewhere in the world. That's true. But yeah, just be mindful of that. Do you think HIMS may rebound in October? We can take a look at the seasonality as well. 11:45 p.m. here. The conversion gets me. Agreed on the red is a buy day. Did you go to check Sydney? Go near Crown Sydney, brother. So yes, please do share recommendations if you are in Sydney or if you're from Sydney. I'm more than happy to also meet. I'm always open to getting to know you, because I know you all know me and you all see me all the time, but I really want to connect with everyone that I can from all parts of the world. We do a lot of these meetups so that we can get to learn about each other and help each other. That's what this global community is all about. And that's why I'm so proud of what we have built here, because of how amazing, inspirational, motivational, respectful, supportive all members are, regardless of where we come from, right? That's what makes it so special and unique, that we're all here together to learn about markets, trading, investing, fundamentals, and technical analysis, and then we can bounce ideas off of each other, learn from each other, because there's always something to learn from everyone, right? Doesn't matter who you're sitting across from, you could always learn something from them. So that is why I love this so much. And if you are in Sydney, if you are going to be in Sydney for the next, let's say, 5 days, let me know, and I'm more than happy to arrange something where we can all get together and have fun. I'm in Melbourne. Yeah, I know a lot of people in Melbourne. I haven't seen a lot of people in Sydney though. A lot of people in Melbourne or Perth. I don't know. Are those cities like, I guess there's different metrics to everything, but in between those three places, isn't Sydney the most populated though? And I think Melbourne might be the second most populated. I could be wrong, but correct me if I'm wrong. So Jeremy, do you have any crazy thoughts on Grab as a business and its growth? So I do like Grab. I actually used it a lot when I was in Bali. So Grab is what I used almost every day to order coffee, to get some rides around the city. And it's a good app. I just fail to see where the moat is. For any company to be strong and successful long-term, it has to have a very strong defensible moat. There's three things, right? Defensible moat, large market, and good management. If you have those three things, the chances are the company is going to be very successful. And a lot of the companies, a lot of the great success stories like Palantir, all right, Nvidia, Tesla, Amazon, Microsoft, Apple, like a lot of these, Google, I mean, they're the only ones in the world doing what they do. So they've got a defensible moat. There's not a lot of competition piercing through their margins. They've got a large market that they operate in, right? So if it's a small market, it still doesn't help us. Doesn't matter how great or how differentiated you are. If it's a really small market, your growth potential is tapped. So you want a really large market with a very strong defensible moat, and then you want good management to just execute. And Grab is a phenomenal company, great app. But obviously it's very geographic specific. Some places use Grab. Like I've used Grab in London, I've used Grab in Bali, but then I haven't used it anywhere else. Everywhere else I use Uber or a similar version of that application elsewhere. So I kind of fail to see where that mode is. Maybe I'm missing something, but I'm gonna take a look into that a little bit more to better see or better understand, like if there's anything there. If maybe there is economies of scale, maybe once they have more users, their margins will grow, they can offer other services that will benefit and complement what they're already offering, and that as a result it's going to lead to more revenue and more margins and so on and so forth. But of course it requires a little bit of a snowballing effect as time goes on. All right, everyone, let's see. Now, Perth, good time to watch now, 10 p.m. and watching with Bear is good atmosphere. Yes, Jerome Powell is taking the stage very, very soon. So in about 8 minutes, we've got Jay Powell's speech coming up. Do me a favor, participate in the poll. So make sure you let us know what you expect from this speech today, whether Jay Powell is going to be hawkish or dovish. And once again, share this live stream with other traders and investors. More people can join us, your friends and family, so we can take a look at this very, very important Jackson Hole Economic Symposium today as Jerome Powell speaks in about 8 minutes or so. Markets are still pushing up. So we got the S&P 500 up over 0.5%. We got Tesla, SoFi, Nvidia, almost all Magnificent 7 stocks except for Microsoft, but that is basically flat. Nvidia slightly down as well. Everything else is green and pushing higher. And in terms of sectors, we do have, once again, most of them pushing up as well. Gold is slightly lower at just under $33.40 per ounce. So here we go. It's going to be a good one. Yeah, a lot of people expecting Powell to be hawkish, 61%. Yes, it's the same as bullish or bearish. Hawkish is just that he's going to be more resistant to rate cuts. He's not going to be very vocal about quantitative easing. He's going to come off as somebody who is somewhat bearish on rate cuts. So hawkish is essentially not exactly bearish, but somebody who's going to be resistant to quantitative easing. He's going to be like, no, we're going to keep rates where we are. We're not expecting a lot of rate cuts, so on and so forth. And then, of course, dovish is the exact opposite, where he's going to be like, yep, rate cuts for everybody. It's all over, and we're floating. We're going to be giving out very cheap money very soon. And then for that reason, the markets could see that as a very bullish, optimistic sign for them to go higher. So Vault, yes, your messages are coming through. I can see them just fine. So feel free to ask any questions. Dump it now. Ishwar says, Stefan, stock on starting blocks. Bobby, can't believe people are thinking he's going to be hawkish. Yeah, I mean, there's a lot of fire with Trump, right? So of course, Donald Trump has been targeting a lot of people from the Federal Reserve, from the FOMC, and as a result, he's kind of somewhat influenced or starting to influence how the FOMC members think about rate cuts and rate hikes. I mean, if you got the FOMC minutes, right? The FOMC members are so divided on where to go from here because of the influence. In the past, we've seen majority unanimous decisions or majority decisions, but now we're starting to see some real division in FOMC as to what to do with rates, whether to raise them, keep them where they are, or cut them moving forward. And to be honest, I don't blame them. With all this chaos around tariffs and inflation, it's hard. It's hard to make a decision on whether to keep rates where they are or to cut them. But I will say this, it's a lot easier to cut rates than it is to raise rates. So as I've mentioned before in my previous updates and videos and live streams as well, the risk of cutting too early is far greater than the risk of waiting in this case. And, the Federal Reserve needs to be, like I said, reactive on the way down, but proactive on the way up. And I still very much believe that's the case for any Federal Reserve in the world. And that's partly because interest rate hikes don't happen overnight. They happen over a course of many, many years as the economy starts to adjust to the higher interest rate environment. And so they don't have the liberty to jack up rates by 2 to 3% overnight, but they do have the liberty, they do have the flexibility to cut rates by 2 to 3% overnight if the economy needs it. So with that sense, the timing of a rate cut is far faster than a timing of a rate hike. And so as a result, as I've said before, Jerome Powell and the Federal Reserve would be better off if they are reactive on the way down, meaning if there's something broken, if unemployment starts to go haywire, they can cut rates to control that immediately. They can do that very quickly. But on the way up, they need to be proactive. They need to read into that situation far earlier because it's a lot more difficult to control inflation once it's already out of the bottle. And it's also not like they can raise rates overnight. They have to do it periodically over many, many months and years. And so it takes time. So in my opinion, proactive on the way up, reactive on the way down. And right now, if I were on the FOMC, I would actually, and I know a lot of people won't like this answer, but I would caution against a rate cut. Reason being is because inflation is still somewhat elevated and unemployment hasn't broken yet. Interest rates at the end of the day are really just a tool the Federal Reserve uses to meet their dual mandate. And why do we use tools? We use tools if something breaks, right? So we use a tool to fix it. And right now, nothing really is broken. Everything seems to be very much fine. Economy is strong, unemployment is low, inflation is somewhat on the rise. So there isn't anything broken that needs to be fixed from the FOMC. So, and I know not a lot of people would like that answer, but hey, that's how I view the current situation, and that's what my analysis and opinion concludes me to believe. So that's where we are. Okay, let's see. Trump will try to name his successor noon to blow off the losses. Watching from Cambodia, shout out to you. Again, let me know where you're joining us from. I'm more than happy to, definitely learn where you're tuning us from, and of course, give you a shout out because I'm sure we've got lots of people from all parts of the world watching right now as we've got Jerome Powell taking the stage in about 2 minutes here. So hope you all are ready, and let me know where you are joining from. We got Germany in the house. We got Nepal, London. That's incredible. Luxembourg, Malaysia. Yes, Suhat Patel, I'll get back to you on that. If you can create a ticket on Discord, my team will get back to you right away. So please make sure that you create a ticket that you can't log in or you can't sign up, and then my team will get back to you as soon as possible. Ahmed from Dubai, Florida, amazing. Bangladesh, we got Zurich, Switzerland, Canada, Australia, shout out to you guys. Tunisia, Pakistan, Canada, Hong Kong, California, India, awesome. North Korea, Taiwan, we got New York, Italy, Charlotte, North Carolina, Hong Kong, we got Switzerland. Mahal, thank you so much for joining. Got Poland, San Francisco, Spain, Malaysia, Orlando, Connecticut. Awesome, you guys. Shout out to everyone as we are getting ready for the Jackson Hole Economic Symposium. We actually got quite a few people from Dubai. We definitely got to do a bigger Dubai meetup very soon. We got Jamaica, Philadelphia, Houston, Texas, Boston, Japan, Saudi Arabia, Denmark, New Jersey. With COVID in Bay Area, Harish, take care of yourself. I hope you feel better. Singapore, got Sydney, perfect. Probably very close to you, depending on where you are. We got New York, from space, Kuwait, awesome. San Antonio, Texas as well. All right, everyone. So we are just about ready for the speech here, and let's do this.
Consensus. Did the dots stay?
Look, the dots are, it's all the communication tool.
Also, let me know if the audio is good, right? So just let me know if the audio is working. If you can hear this, okay?
Away, unclear exactly how he prepped for it. How do you think he prepped?
He had breakfast at the Pioneer Grill.
You saw him?
I said good morning to the chairman this morning, and I didn't see if he went healthy or full English.
Oh, yeah. I can guarantee he didn't go full English ahead of this, but this is going to be a monumental moment for him. His last speech at Jackson Hole as Fed chair, with the whole world watching. Does he address independence? Does he deal with the inflation side of the mandate more than potentially the labor market side of things? And frankly, the international feel here, really notable, as you mentioned.
To me, that's a major theme for me, is the international community is screaming.
Yeah. Micah has some headlines.
The headlines are out. The chairman has started speaking, and here is the key phrase. The shifting balance of risks may warrant adjusting policy. That's going to get Wall Street's attention because it's opening the door to a rate cut. Here's the key sentence. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting adjusting our policy stance. The Fed is also announcing its new framework, which is pretty much as we were just talking about with Pat Harker, dropping the reference to the effective lower bound, eliminating the inflation makeup strategy, committing to contain inflation expectations and concern about labor market shortfalls. But the key here is that there are downside risks to employment, the Fed chairman says. The inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising, the S&P 500 now up 1.3%, yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through?
And inflation, though still somewhat elevated, has come down a great deal from its post-pandemic highs. At the same time, the balance of risks appears to be shifting. In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point. The labor market remains near maximum, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic, Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations, to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher, and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
Thank you very much. We'll move into the presentations. So I want to allow a minute for all of the members of the press to go.
All right, everyone. So what we have here is a very dovish Fed. FOMC is indeed very, very dovish. Jerome Powell was very vocal about potentially in the shift of the interest rate policy moving forward, as the balance of the risks have shifted. There is more upside risk for inflation, but a bigger downside risk for unemployment. And as a result, they are definitely weighing in the potential for rate cuts later this year. And markets, of course, booming right now. S&P 500 is up over 1.26%. As Jerome Powell mentioned earlier, this was indeed his 8th meeting at the Jackson Hole Economic Symposium. The last 7 times, as I mentioned in my previous update, there was a 71% in the past that markets were higher on the day of. And so far, of course, we also do have the markets higher on the day of Powell's speech here. And we'll see how we end up closing the day as well. But so far, so good. I mean, Tesla's rocketing higher, 4%. We got Nvidia up over 77 basis points, back over 176. We got SoFi pushing up almost 4%. And then, of course, Tesla. We got Google, Meta, Amazon, Apple, Microsoft. Everything is once again pushing higher. So if you take a look at the rotation and, of course, the inflow of capital, another half a $1 trillion started to flood in as Jerome Powell started talking. And from 30 basis points, we are now up 1.3% at over $748 billion worth of inflows. And the MoneyVest Index now further into optimistic. And that was a pretty big spike here from 3.58 to 3.83. So that was obviously a pretty substantial increase in the MoneyVest Index, getting back up to almost almost greed here. We haven't really hit greed all this year. 2025 has been 3.99, 3.98, but hasn't really crossed over 4. So what does everyone think? Is there a rug pull incoming? Let's just do a very quick poll. One final poll for a potential rug pull, or are you expecting this for a continuation? Markets rug pull or continuation? And let's just do a very quick poll here, as we have 1,400 members watching right now, and volatility, of course, also dropping dramatically here, over 11%, back under 15 at the moment. And then if you come take a look at the 10-year Treasury, it is also dropping a little bit over 1.5% on these optimistic expectations that rates are indeed going to get cut later this year, and 4.17, 4.2% is really a very strong area of sort of support for the 10-year Treasuries, where we have been hovering in for quite a bit of time. So absolutely incredible momentum coming in from the Jackson Hole Economic Symposium speech of Jerome Powell, and of course the markets here rocketing higher. Portfolios, I'm sure, are absolutely pushing up as well. My options portfolio is actually back up to all-time highs. You know what? I'm going to bring that up very quickly just so everybody can see that and see my positions as well. But yes, definitely do take part in the poll as well, and whether you're expecting some continuation or a little bit of a rug pull in this market. So let's just do that as well. And 1 second. Okay, so this is what it looks like right now. I'm just going to open that up, and all right, here we go. Okay, so that's the portfolio. Of course, I've got the BITX position, Ethereum's, Hims and Hers, Nvidia, Oscar, we got SoFi, Tesla, and on the day, obviously markets pushing higher, 2,700. This was basically flat before Jerome Powell started talking. We're seeing a little bit of momentum lower. We're seeing just a little bit of this pullback from the markets, but we'll see how the markets trade rest of the day, as 54% majority of people are actually expecting this to be a bit of a rug pull in the markets. So a lot of skepticism around this market rally. Am I right? So yes, we're seeing quite a bit of skepticism here in this market, as investors, including 1,400 people watching right now among these polls, are not fully convinced that this move is actually going to hold up in this market. So coming over to cryptos as well, just to quickly take a look at what is crypto doing. And we've got Bitcoin just about $115,000 right now, and Ether is just over 4,500, also pushing higher, 7.5%. And as a result, I'm sure Ether ETFs, this one is up over 8% right now. Then you got ETHU, so that's the 2x volatility. It's up over 16%. Let's take a look at BMNR. Over 6.5% right now. And then let's take a look at SBET. It is also up over 9%. So crypto is indeed booming. More specifically, Ethereum is pushing higher. And of course, Bitcoin is also up over 2% as well. So that's where we are, everyone. Again, the options portfolio back at all-time highs at just shy of 251,000, up almost 3,000 on the day here. I'm going to get some sleep, as it is well past midnight here in Sydney. So thank you so much for joining. I really appreciate that. And again, if you want to get access to all the trade alerts and of course members only videos, portfolio updates, everything, all of that is going to be available. There is an annual discount available until the end of this month. And if you have any questions whatsoever, just email me at admin@moneyvest.com, and I'm more than happy to jump on a one-on-one Zoom call to help you. I'm usually pretty packed in back-to-back meetings, but that is the whole point. That's my purpose. That is why I'm doing this, so that I can help you in your trading and investing journey. So if you have any questions about anything, what we have to offer, different courses, of course, alerts, members only videos, portfolio updates, our shopping list just got updated yesterday. So if you go over to the MoneyVest website, which is going to be right here, and you go over to the shopping list here, it has been updated on August 21st. So yesterday I updated the shopping list with the brand new buy targets and fair values. And of course, I'm going to be adding new stocks into this as well over the next few days. And these are going to be 6 to 7 brand new companies as well. So market's pushing right back up. S&P is up over 1.5%. Congratulations to everyone. Quickly going over to the NASDAQ. It's up over 1.7. So a lot of liquidity flooding back into big tech. So market concentration over 279, almost $280 billion coming into Magnificent 7 with the top 10 stocks over 320 billion. Of course, a lot of that coming from Tesla, Google, Apple, Amazon, Nvidia, Broadcom. You know the ones which are obviously the perfect one. So when will be the time to buy? So Emre, we look at a lot of different indicators such as volatility, the MoneyVest index, valuations, market breadth, technicals, RSI, momentum. So the entire MoneyVest dashboard helps us better judge the market temperature and the conditions. And when the risk reward is incredibly favorable in our favor, that's when we deploy capital a lot more aggressively. But in markets like right now, we are just sitting back, enjoying the gains, enjoying the profitability in this market. So hope you all enjoy your day. Have a fantastic weekend. I'll see you all very soon. Make sure to drop a like and subscribe to the channel. Again, links going to be down below if you're interested in joining us. Happy